Good morning, everybody, and welcome to What's Hot on the Open. We're taking a look at all of the action on the U.S. markets here at MarketStream.live. My name is Joseph Cusick with the Cusick Group. Securities offered by MoneyBlock. Let's jump in. Dow Jones trading down 52 points at 20,599. Tight range this morning, but trading on the lows. What's notable at this juncture is two things. One is this consolidation keeps getting tighter and tighter, right? It's like a wound up coil at this juncture. And I think what is going to be the catalyst is, as far as data is concerned, is going to be the earnings tomorrow morning in the financials. This is an area that is going to catalyze the markets, and it's going to be highly anticipated. We're going to watch JP Morgan, Wells Fargo, and Citibank report tomorrow morning. This is going to start setting the tone for the earnings season, and specifically for financials. Now, also what's notable is that you're starting to see that every single one of the Dow Jones components is trading at an IV rank that is basically above 50. What is that telling you? That those that don't follow IV, that's telling you that there is a heightened anticipation of potential violent moves in these blue chip stocks. Now, it could be either up or down. But at this juncture, those stocks are getting into a range where they're getting expensive in terms of volatility, and there's a higher anticipation of potential violent moves in these stocks. And we're going into our earnings cycle, so there are binary events, as I call them, that could be moving these names. You need to be paying attention, not just with the geopolitical risk, because to be quite honest with you, as I was talking to one of my good friends that's in the institutional bond business, he basically said he can't believe how thick-skinned investors and traders are these days to the events that are occurring both geopolitically and from the terrorist components that have been out there. He couldn't believe it. And we're numb to it. And it's an unfortunate state of affairs. But with that being said, knowing that the IV ranks on all 30 of the stocks that are in the Dow Jones are at 50 or higher, that is telling you that there is an anticipation of potential violent moves in these stocks going into this earnings cycle. I wanted to point that out. Taking a look at the S&P 500, really right now you're seeing that the S&P 500 is caught in a very tight consolidation, down 440 today at 2349.40. Again, the S&Ps are going to stay in this tight range, but we're seeing volatility expansion, which is telling me that these S&P put options, those protective options, those options that will appreciate in price if the market drops, they're starting to become more expensive. In other words, there is a premium being put on insurance policies, so to speak, in the S&Ps, and that's reflected in the VIX, which we'll touch on in a minute. The NASDAQ has been under pressure for the last few sessions. It's actually dipped below its 20-day moving average. That means that the short-term bulls in the tech-heavy sector are now on their heels. That means that they're going to have to either dig in, or you're going to start to see a challenge of that 50-day moving average, which hasn't been challenged in over 6 to 8 months. You've seen a consistent trend to the upside. Right now, 5,400 was the mark that we wanted to watch. It has been broached. The NASDAQ is down 660 at 5391.90. Now the next level that you're going to want to watch is 5,300, which is 90 points away. And that'll be the next challenge point. The Russell 2000. This is very sensitive to the data that continues to come out here in the United States. I think there's a little of uncertainty that's starting to creep in the market. And I'll tell you why I'm saying that. Just look at the bonds, folks. But the Russell 2000 is going to be extremely sensitive to the future economic data that's coming out, as well as the proposed plans. Tax cuts, healthcare, and infrastructure are going to drive these stocks. If we don't start to get some movement on those three issues, you're going to see that the Russell 2000 could potentially come under pressure. Right now, the Russell is giving up most of its gains that it had yesterday. It's down $6.19, down exactly 0.45% at 1370.79. This is right at that blood point of the 20 and 50-day moving average. This is acting as support right now because it did settle above there last night. But again, the short-term and intermediate-term small-cap bulls are on their heels. Let's see if that actually plays out. Taking a look at the VIX continues to go up. This is telling you that there's increased fear in the market. Now, from a macro or from a macro perspective, as far as volatility is concerned, 15 VIX is still cheap. But when you look at it over the last 52 weeks, this rank of as far as where the VIX is trading at 1560, it's at like a 65, almost a 70% implied volatility rank. That means that volatility is trading at the highest levels that it's been in almost a year. So there is a heightened expectation of potential risks. This makes sense with the geopolitical issues. You have the Syrian conflict, you have Korea, you also have a very volatile situation starting to resurrect itself in the French elections. You're going to have the first vote on the 23rd of April. Once the two candidates are determined, then you will have the final vote on March 7th. There is a right-wing and a left-wing candidate that are running neck and neck right now. The right-wing candidate wants out of the EU. The left-wing candidate, which is the communist candidate, saying, hey, let's stick with our programs as we have them and actually build it out for the common man. It's a very interesting dichotomy that's breaking out there, and volatility is really starting to resurrect itself, and you're seeing it reflected not only in the currency markets with the euro and the dollar continuing to be mixed, but you're also seeing it in the bond markets. And I wanted to spend a little time on the bond markets because we were talking about a flattening yield curve, and I had some questions. What do you mean flattening yield curve? What it means is that right now we're seeing currently yields have been pulling down. But what's been noticeable is that the 2-year note and the 10-year Treasury notes, they have not been dropping at the same level. As a matter of fact, you've seen that the 10-year has been dropping faster as far as yields are concerned than the 2-year. That means that the curve is starting to flatten out versus the shorter term versus the longer term. What does that mean for you as a trader? Well, there's a handful of things. There are a plethora of things that it could mean, but what do you need to really kind of take away from yields coming down, prices still holding up in bonds, and the differential between the shorter term yields and the longer term yields? And remember, those shorter term yields are more sensitive to things like what the Fed's doing, raising rates and so forth. But really what it's telling you is that currently the current bond buyers, they're basically not buying into the economic acceleration that we're all anticipating and have anticipated since post-election. You're also seeing that they're not buying into the fact that the expectation of heightened or exponentially greater inflation is on the forefront. The other thing is that there's an anticipation potentially of an equity correction. We've been waiting for it for 2 years. But the point being is that right now, with all of the geopolitical, with some of the mixed data that continues to come out, but still strong, and the fact that you're seeing not only the federal government here in the United States pull back from its capital injections, but you're also seeing other central banks putting up that they're potentially going to be pulling back. You're starting to see that the markets might be saying, you know what, maybe there's a correction that could happen, especially if we don't have that backstop. The other thing is that there's basically foreign buyers. They could be coming in and continuing to embrace the differential trade between their bonds and the U.S. bonds. Another point could be that a geopolitical flight to safety, as we've discussed. And the final one is, and this is one that I haven't heard a lot about or a lot of discussion, but baby boomers. This could be actually a segment that's saying, you know what, I want to guarantee, right, a more secure post-retirement. You know, baby boomers are in that stage. 65, 70-year-olds are looking at it saying, you know what, I'll take the price risk. I'm just looking for a guaranteed rate. 2.5, 260, that's fine for me. I can live on that. That could be also a segment and one of the reasons why you're seeing a current bid in the bonds. All right, folks, that's it right now for what's hot on the open. Join me for Strategy Now at 1:30 Eastern Time. I'm going to bang out some strategies for you going into the long weekend. And with volatility, let's see what we should be paying attention to. What are the types of strategic approaches as well as positional management approaches we should be taking with heightened implied volatility. That's it right now. Join us at 1:30 Eastern Time for Strategy Now here at MarketStream.live. Have a great day.